So, Marilyn, there's this contract on Kalshi right now, right? It's about federal AI regulation, whether it'll actually happen by like December 31st, 2026.
Yeah, the Fed AI Reg 1.
Exactly. And the chatter around it, all the wire coverage, the legal trade press, even those framework rollouts, they're pricing that outcome at, like roughly 85% probability. But then you look at the actual order book, it's sitting at 62. That's quite a difference, isn't it?
Oh, it's huge. I mean, think about it, Marcus. 23 whole points. That's skin in the game capital, real money, pricing it 23 points below what everyone else, the so-called institutional consensus, is saying, on a question with a super clear hard calendar resolution, too. It's not fuzzy.
Wow, 23 points. So that gap, is that like a direct signal we can just read?
Absolutely. That gap, it is the signal. And what we're going to do today, really, is figure out how to read it. By the end of this episode, you'll totally get what produces a spread like that between basically declaration and actual execution. When it gets bigger, when it shrinks, and what it tells you, crucially, about every other institutional commitment you're being asked to trust, It's not just about AI.
Okay, but before we dive into reading that gap, what's the standard narrative everyone just jumps to first?
Right. Before we read the gap itself, we need to look at that frame everyone reaches for immediately. It's always fragmentation versus unification, right? You've got the federal podium on one side and then, 50 state legislatures on the other. And December 31st, 2026 is that resolution date.
Yeah, I've seen that. Like the Phoenix Governance Report frames it that way. Kalshi's session report too. Even the legal trade press, it's all that framing.
And that frame, honestly, is the load-bearing assumption I just really want to pressure test, Because if that cracks, the whole question it totally changes shape. And that 23-point gap we're talking about, it stops being a transition signal, and it starts being something else entirely.
Something we, don't even have a name for yet, huh?
We will by the end of this, trust me. So let's start with what's actually in motion, okay? December 11, 2025, Executive Order 14365. It declares a national AI policy framework, and it specifically instructs the Attorney General to challenge state AI laws, which is big.
Wow, okay.
Then, January 9th, 2026, the DOJ AI Litigation Task Force gets constituted. And this group, Marcus, they've got sole responsibility to litigate against state AI statutes. That's their whole job.
So the federal apparatus is really moving then?
Oh, totally. And then March 11, 2026, the Commerce Department's evaluation of what they call burdensome state laws is due. And March 2026, the White House releases its formal legislative recommendation. That's the federal side, in full force.
Okay, so that's the federal apparatus, just like getting everything in order. What about the state apparatus? How are they responding to all this?
Oh, the state apparatus? It's bustling too. We're talking over 600 AI bills carrying private entity requirements introduced in 2026 sessions. And get this, roughly 400 of those are currently pending. It's a lot, right? Colorado's AI Act, for example, it takes effect June 30, 2026. And Governor Polis, he's actually released a replacement bill that explicitly preserves the state's regulatory ground, rather than giving it up.
So they're, digging in.
Totally. And California's TFAIA, that went live January 1. Texas's Responsible AI Governance Act, same date. New York, Illinois, they're all adding statutes. The federal framework, it characterizes these laws as imposing undue burdens. The language of cost to be reduced, like a tunable parameter inside some optimization function.
And in the order book, the Fed AI Reg contract is just sitting there at 0.62.
Exactly. So the standard frame, as you said, is federal apparatus pushing toward unification, state apparatus pushing toward fragmentation. They collide, and whichever wins resolves the contract. That's the frame the executive order itself even uses, to be fair.
But you're saying there's a problem with that frame.
Oh, there's a big problem with that frame, Marcus. The executive order, it actually already conceded fragmentation. You gotta read Section 8 of the order really, really carefully. The legislative recommendation it directs, it's a federal framework that would preempt state AI laws, but explicitly not state laws relating to child safety, not state laws relating to AI compute and data center infrastructure, except for, generally applicable permitting reforms, and not state laws relating to state government procurement and use of AI.
3 exemption categories written into the order itself then.
3 categories that cover an enormous slice of the state legislation we just listed, right? Texas's RIGA centers on government procurement and use. California's SB 243 is companion chatbots, child safety. A substantial share of the bills coming out of the states this year are either child safety or procurement. The federal framework, the unification framework, is on its face just not a unification framework. It's a partial preemption framework that has already accepted that significant categories of state regulation will continue.
So when wire coverage prices unified federal AI regulation at 85%, what's actually being priced is
A regime that, in its strongest possible victory, leaves child safety, data center infrastructure, and state procurement untouched, plus everything Congress doesn't preempt by statute, plus everything the courts decline to preempt by ruling, plus everything the FTC and FCC can't reach through agency action. It's a lot of plus everything.
Here's a way to picture it, I guess. Imagine the United States announces a single national time zone. The declaration is issued, the framework is published, federal agencies begin operating on Eastern Standard. Then you read the announcement closely. It includes a clause stating that state-issued clocks for hospital schedules, school calendars, and municipal services will continue to display local time. The single national time zone has been declared. The clocks have not changed. Anyone showing up on time anywhere in the country is using a state clock. The federal time exists on the press release.
That's the frame being priced at 85%, Marcus.
And the order book is pricing it at 62.
The order book is pricing the question more accurately than the narrative is even formulating it. And this translation gap, it's not just AI. It's a spread that's like widening across multiple institutional categories simultaneously. It's kind of a big deal, you know?
Oh, interesting. Where else are we seeing this?
So this spread on Fed AI reg isn't like a one-off anomaly.
Nope, it's a sample, one of many. And this systematic widening, it's actually creating something new in market structure. Capital is starting to price forecast credibility, like the institutional probability of delivery, as a totally separate variable from the actual outcome itself.
Whoa, that's a new spread then.
It is. It's a measurable distance between this will happen and this institution can actually deliver this. 20 years ago, you'd price outcomes against macroeconomic conditions. Now, you price them against execution probability. The execution discount, it's becoming its own asset class, you know?
Okay, so project that forward like 5 to 10 years out. What does this become?
Oh, it's going to be a formal risk premium category. Right now, traders are pricing it intuitively, contract by contract. But within 5 years, I guarantee you, there will be index products that explicitly track institutional execution probability spreads as a measure of regime durability. Sovereign credit derivatives already do something kind of similar for fiscal credibility, right? This is the next iteration, regulatory and policy credibility priced separately from the actual outcome.
And what's actually driving this? The mechanism behind it?
It's the accelerating gap between institutional declaration cadence and institutional execution capacity. AI adoption is the most visible case because the technology, it iterates so much faster than any prior general-purpose tech. The Federal Reserve Bank of Atlanta CFO survey, over half of firms have invested. The Fed's notes from late March show over half the U.S. working-age population is using generative AI. The technology is moving in months. The Commerce Department is 47 days overdue on a single evaluation, Marcus.
The institutional clock it can't keep pace with the technological clock, huh?
That's it. That's the mechanism. And the further that institutional clock falls behind, the more declaration is used as a substitute for execution. Because declaration, well, it's the only output the institutional clock can still produce on the technological clock's timeline, which means the spread, it won't narrow, Marcus. It'll widen.
Here's a useful way to picture it, I think. Like, how does a credit rating work? The rating doesn't measure whether the entity has the assets to pay, right? It measures their forecast credibility, the probability that what they say they'll do is what they'll do. A AAA rating is high forecast credibility. A downgrade, it's the market saying, we believe the asset position less than we used to.
Oh, exactly. What we're watching, it's a sector-wide credibility downgrade on institutional declarations as a category, without anyone formally issuing one, you know? The Kalshi book, it's doing the rating.
And the rating it's issued on Fed AI Reg is sub-investment grade. Ouch.
Now let's Let's put some pressure on something we just kind of built.
Go.
Okay, so I claimed that 23-point gap exists because the unification framework is structurally fragmented from the start, right? That it can't deliver what's being priced. Push back on that.
I'll still man it for you. The federal preemption case isn't every state AI law gets preempted. It's the cost of operating under a single national jurisdictional regime, even one with 3 exemption categories, is dramatically lower than under 50 state regimes, plus 3 exemptions. Compute clusters cross state lines, models train globally, inference happens in milliseconds. 3 carved-out categories don't structurally fragment that core. So even partial preemption is, for the operators that really matter, effectively unifying.
That's a good steel man. I mean, it really is.
And it follows that the Kelsey book is maybe mispricing the question. A 0.62 probability assumes full preemption. If the question is, does meaningful preemption pass, you should be at 0.75 or 0.80, not 0.62. The book is just being too literal about what counts as a win, maybe.
Okay, that's the steel man. Now, apply pressure. The framework requires Congress to enact it. Section 8 of the executive order is explicit. The executive can recommend, but only Congress can preempt by statute. So the binding question becomes, does Congress pass it?
Right.
Congress voted on a 10-year moratorium on state AI laws in the Senate. The vote was 99-1.
Against the moratorium.
Against. 99 senators, both parties, voted against preempting state AI law. Then, Congress declined to include AI preemption in the One Big Beautiful Bill Act. Then, they declined to include it in the FY 2026 NDAA conference report, explicitly excluded it because the approach drew bipartisan criticism from both state and federal policymakers. That's 3 sequential rejections of the exact mechanism your steelman requires, Marcus.
Oh, wow. So the steelman assumed Congress would, act.
Yeah. It assumed the only obstacle was state resistance, but the actual binding obstacle is Congress itself, which has rejected the mechanism 3 times, in 2 of those cases unanimously, or at least near unanimously. 99 senators, Marcus. They treated preemption not as a tunable parameter, but as a hard boundary they just wouldn't cross. The steelman, it just doesn't survive that.
So then what does survive?
The order book is pricing the question more correctly than I even priced it a moment ago, honestly. The 0.62 isn't some literal reading of the contract. It's an aggregate of 2 big facts. The framework is structurally fragmented, even at maximum success, and the legislative path required to deliver any preemption has been rejected 3 times by the body that actually has to enact it. That 0.62, it might still be too high, not too low.
So the actionable revision is,
The frame unification versus fragmentation predicts the wrong things, like totally wrong. The frame declaration versus execution capacity predicts what we're actually observing. What capital is pricing isn't which side wins, it's how much further the declaration can run when the execution capacity has been visibly absent for 3 legislative cycles in a row, you know?
the argument that went in just got replaced.
That's what was supposed to happen. So when you see a 20+ point spread between institutional narrative pricing and capital priced execution probability on a hard timeline question, the gap, it is the signal. Don't try to pick the resolution direction. The resolution direction is the wrong question to ask.
The right question is, how much further can the declaration run without an execution event? That's what the spread is measuring.
And it's totally portable too, right? Run the same read on Federal Reserve forward guidance against futures pricing, on corporate earnings guidance against options implied volatility, on any statutory deadline that has come and gone, the Commerce Department evaluation, 47 days overdue. That's its own reading. Each of these is a small instance of the same diagnostic. Build a habit of reading the spread, and you'll see something the narrative on its own can't show you.
Here's what stays with me. The frame everyone reaches for is that this is a transition state, right? Declaration plus fragmentation now, resolution to one side or the other later. December 31, May 12, the next CPI print. We treat the spread as something that has to close.
And if it doesn't, Marcus?
then the spread isn't a transition, it's the steady state.
Exactly. The system has stabilized into a configuration where institutions declare and capital prices the gap. Both functions continue. Neither produces an execution event. 3 legislative rejections, a 47-day overdue evaluation, a Senate vote of 99-1 against the mechanism. That's not stress on the way to resolution. That looks more like equilibrium, doesn't it?
Which means the question is no longer which way it resolves.
No, it's how long this configuration holds before something else breaks. And the something else won't be the AI regulation question, surprisingly enough. It'll be the next institution downstream that has been quietly absorbing the same translation gap. The University of Michigan's record low sentiment reading is one, for example. There will be more, and they'll come from places we're not currently watching, you know?
Wow. So read the spread. Watch what cracks first.
Exactly. It's like the most important thing to take away from this. It's happening everywhere, quietly, and it tells you everything.
Well, Marilyn, this has been an incredibly insightful discussion. Before we wrap up today, I really want to thank all our viewers for tuning in. If you've enjoyed this deep dive, please remember to hit that like button, leave a comment, subscribe to the channel for more content like this, and best of all, share this episode with someone who you think needs to hear it.
And if you do, tell them to read the spread, because that, Marcus, is the core takeaway. The institutional declarations are one thing, but the execution capacity, the actual ability to deliver, is being priced entirely differently now. It's a systemic shift, not an anomaly.
A systemic shift where the spread isn't closing, but becoming the new equilibrium. That's a powerful and, frankly, a bit unsettling diagnostic to carry forward.
Unsettling, perhaps, but undeniably actionable. Knowing where to look changes everything.